Through its research and convenings, the Center on Philanthropy and Public Policy seeks to make philanthropy more impactful today and to create a smarter, stronger sector for tomorrow.
Good afternoon, everyone. I'm Jim Ferris, and I'm a professor in the Saul Price School of Public Policy at USC. And I have the pleasure of serving as the director of the USC Center on Philanthropy and Public Policy. On behalf of the Center's Board of Advisors, I'm delighted to welcome you all to this conversation on philanthropy, impact investing, an opportunity to make a bigger difference. We are now in the third year of this new series, Conversations on Philanthropy. Many of you have been to other events we've hosted, the National Leadership Forum, the Distinguished Speaker Series, and even some of our research roundtables, which we've been doing since the inception of the center. This series is a bit different. It is an effort to have a more intimate, in-depth conversation on issues that are of keen interest to the philanthropy in our community. When we designed this series, our idea was maybe to have 30 people in the room for a very interesting, in-depth dialogue. But you see, when you have star power like we have today, you just can't keep people away. So we're delighted to have such a wide spectrum of leadership from the philanthropic community here in Southern California. Over the past several years, there has been a focus on how foundations and philanthropy can increase their impact beyond their grant making. Among the strategies that are being explored is how to put all of their assets into play to have a greater impact on their mission. And a new field has been developed at a relatively, actually an extraordinary pace, perhaps not fast enough for some and maybe too fast for others, but to provide capital in innovative ways for the social good. Indeed, in a recent scan of 20 foundations here in Southern California that we did with leaders of some of the more prominent foundations, nearly 3/4 of the foundations said they had used or are interested in using program-related investments as a strategy for impact, and almost half of the 20 foundations said that they have recently discussed mission investing or are interested in doing so. As one leader explained, what we're intrigued by is the idea that you shouldn't always start with the notion of how can a grant help. You should just start with how can we help and then use the appropriate tools to accomplish that goal. So I want to thank Antony and Andy for joining us today on this last day of winter. Welcome to LA. To offer their perspective and insights on how we can make a bigger difference by leveraging philanthropic assets for greater impact. Antony has advanced this field since his days at the Rockefeller Foundation and now at the Nonprofit Finance Fund. And Andrea is working to make it possible for those who choose to invest through her work at Goldman Sachs, developing instruments and vehicles for doing just that. What better experts than for today's conversation? I want to take this opportunity to acknowledge some important folks who have made today possible. Let me begin by thanking our sponsor for today's conversation, the Goldman Sachs Philanthropy Fund, and John Mallory. In addition, I want to thank our first-rate Board of Advisors who provide wise counsel and encouragement to Dean Jack Knott and myself, and who are invaluable in sustaining and grounding the center's work and meeting the challenges facing philanthropy. So for the Board of Counselors, Board of Advisors, I also want to thank our philanthropic partners. They are listed in the programs at your seat. Their support, enthusiasm, and contributions are instrumental to the center's many accomplishments and successes. And finally, I want to thank and recognize the CPP team whose hard work is critical for our successes like today's event. So with that, enjoy lunch, and we'll resume the program shortly after the main course, and Fred will take it over from there. Fred Alie, our board chair, and introduce our speakers then.
Good afternoon. I'm Fred Alie, the president of the Weingart Foundation here in Los Angeles, and I'm also the chair of the Board of Advisors for the Center for Philanthropy and Public Policy at the University of Southern California. So let me also add my welcome to all of you, and I know how busy everyone is in this room, so thank you for spending your lunch hour and plus some time with us today. I have the pleasure of introducing our two speakers today for what I think you're going to find is a very insightful conversation on impact investing. So let me start off by introducing Andrea Phillips, who is a vice president in the Urban Investment Group of Goldman Sachs. Andy has a focus on social impact bonds in her practice and developing community development financial institutions for partnerships around access to capital for small business and economic development investing. And Andy and I were having a great discussion earlier because I noticed on her resume she had a background, I thought, in arts and social services, and I thought, there's hope for all of us in the nonprofit sector because now you're involved in all this very high-powered finance. So I'm glad somebody with your background has accomplished all the wonderful things you have. And speaking of that, Andrea led the investment in the Rikers Island Social Impact Bond, which many of you may recall was the first such transaction ever executed by a financial institution in the United States market. Andrea also led Goldman's second social impact bond with the United Way in Utah, which invests in early childhood education, and maybe we'll hear more about that later. She has over 20 years of experience in developing small business workforce, and community development programs. So Andy, thank you for being here today.
My pleasure.
Andy is going to be engaging our other special guest, Antony Bugg-Levine, in a conversation today. Antony, as many of you know, is the CEO of the Nonprofit Finance Fund, a national nonprofit and financial intermediary that provides financial education, financial advice, and targeted investments for nonprofit organizations throughout the United States. And I should mention that, as many of you know, the Nonprofit Finance Fund opened an office here in Los Angeles a number of years ago. And Antony, I have to tell you, sort of began to raise the financial IQ of many of our grantees and nonprofit organizations in this community. So thanks for that. Antony also oversees more than $225 million of investment capital and a national consulting practice, and works with a range of philanthropic, private sector, and government partners to develop and implement innovative approaches to financing social change. He is also the co-author of the newly released Impact Investing, Transforming How We Make Money While Making a Difference. Antony also, by the way, has a background in philanthropy, having worked at the Rockefeller Foundation, where he led their impact investing initiative. So at this point, I'm going to turn the conversation over to Andrea, who is going to engage Antony in a discussion. And 35 minutes into that discussion, I'll step back up and we'll take questions from the audience. So be writing down your questions, because I know both of our speakers want to hear from you as well. So Andrea, thanks.
Great. So thank you so much for that introduction. And I just want to say it's really, really wonderful to be here. And that's not only because it is such lovely weather. We have had the most miserable winter on record in New York City, and so I am truly delighted to be here in this sunny climate, even if it is still the last day of winter, because this isn't what winter has felt like. So today what we really want to do is start with a little bit of a broad conversation about what is impact investing, talk some about what is the landscape, what are the opportunities that are out there, what the role of philanthropy can be in impact investing, and then also sort of do a little bit of a look forward. And I'm thrilled to be here with Antony, who I've known for a long time. I think the best place to start this conversation is to turn it over to Antony to really talk about what is impact investing, given that you literally wrote the book. So
yeah, and it's great to be here with Andy. You know, I think a lot of us have this problem where we're here in LA, really excited to catch up, even though we work less than 2 miles apart. But that's the way that things are, I guess. So you guys are we get to catch up, and hopefully it's interesting to everyone else. And also just want to say thank you to Jim at the center and Fred as well. Fred mentioned the Nonprofit Finance Fund has been in LA with an office here. We're a national organization, but thanks to the leadership of Fred and Berlin and his team and a few other funders, we've been able to bring our work here into the local community, which is something that's been very exciting for us. We'll talk about what it takes to make this work effective, and one of the things it takes is to combine capital and expertise and all the fancy words we use with a deep understanding of the local community in which you're trying to make a difference. And so having that partnership in California and LA has been great for us. But just to get back to Andy's question, what is impact investing? It's either a really obvious idea or a really radical idea. So the kind of going definition is that impact investing is any investment where an investor is trying to make a financial return and address a social or environmental issue you care about. So what distinguishes an impact investment from philanthropy is that an impact investor wants their money back, at least. And it's not always going to work out, but you also want some sort of interest along with your money back. And what distinguishes impact investing from mainstream investing is that an impact investor, in addition to wanting their money back, also has the intention of making an investment for the purpose of solving or addressing a social issue they care about. So on one hand, this shouldn't be so radical. Lots of people in this room have been making impact investments for years. The Hilton Foundation has a PRI program. They make loans, often to their grantees, because they know that those grantees are going to generate some revenues and pay them back. At the Nonprofit Finance Fund, we've been doing this for 34 years. We started in 1980 after the oil price spiked in the 1970s. A lot of social service agencies in New York City were being bankrupted by their heating oil bills. And they went to their foundation partners and said, we're going broke because the heating oil bills have gone up. Give us a grant to make up the difference. And we were born out of the realization that you didn't have to give them a grant because you could give them a loan, which they could use to buy a new boiler that was more fuel efficient, to put in new windows that trap the heat inside, and that their heating oil bills would go down so much that they could repay the loan. That's an impact investment, because when these organizations came and said we want a grant, what the founder of NFF said was actually we can make this a loan. So there is lots of evidence, and you'll hear the two of us, and I'm sure you all have other examples, that impact investing is not crazy because it is happening all around us all the time. So on one hand, it's a very simple idea. On the other hand, it is radical. And the reason it's radical is because a lot of us have been raised into a mentality that says that the only purpose of investing is to make money, and that the only way to solve social problems is to use your grants or wait for government to step in. And impact investing rejects that. So the world that many of us have been raised into has split us and has said investing is only good for making money, and the only way to solve social problems is through charity and government. And here we are as impact investors saying, hold on now, an investment can be a morally legitimate and economically effective way to complement your grant making and actually do what Jim started this whole session with, and start by saying, how do I use my assets to get the social change I want to see in the world, rather than where do I give a grant? So we are boring, and we've been around for a long time. We're also radical, and I think this conversation can probably capture both of those.
That's great. I think that's really helpful context. I think when people think about impact investing, they don't often instantly think of Goldman Sachs. I think folks tend to think of us more on Antony's right hand. But in some ways, our little secret is that Goldman Sachs has been in the impact investing business since before Antony was smart enough to come up with that term. What we've historically called what we do in this space is double bottom line investing. And so about 12 years ago, a small group of people at Goldman got together and formed the Urban Investment Group, which is where I sit. We're now 30 plus people. And we have invested the firm's capital in projects which, as Antony said, both achieve a financial return, we are a profitable business in the firm, but also have an intentional social impact. And we're very proud of that double bottom line. And in fact, so proud of it that recently we launched a social impact fund, because what we've been hearing from our clients is that they're really interested in their own investment portfolios to have exposure to these types of double bottom line investments. And so I'm hoping today during this conversation we can talk a little bit about in detail what those investments look like. For us, it really is about communities and how do you invest in the bricks and mortar that make up healthy communities. It's also about some of the work we've done more recently that's been really, pushing the limits of impact investing and saying, wait a minute, can we use those same tools to finance social services?
Here in Los Angeles, the Nonprofit Finance Fund, or in California, the Nonprofit Finance Fund has done about 20 deals in the last few years, around $36 million of loans. And just a few examples. I know some of you have supported the Alliance charter schools. These are a set of schools that are in low-income communities and have an amazing track record of sending many more of the kids in those schools into college, graduating high school and then into college than a lot of the schools around them. And they had an opportunity in East Los Angeles to put up a new school. Building that school was going to cost about $9 million. And again, I think historically you might have thought, well, this is a nonprofit organization, and if they need $9 million, they should go do a capital campaign. And what we were able to do working with them is to structure a bond purchase. You're a nonprofit. Nonprofits should raise money through capital campaigns, go and get a bunch of donors to fund the money. But it turns out that once that school starts, they're going to have a set of revenues associated with the contracts they have with the state, and we are able to lend against that. So instead of going to get a capital campaign with grant making, they were able to raise $9 million through an investment offering that we and some other organizations like ours made. So that's one example. Another example that I think, again, many of you are familiar with Project Angel Food here in Los Angeles. They're an organization that provides food and other comforts to people with HIV/AIDS and cancer. And they have a different revenue stream associated both with contracts they get from the city as well as some of their rich donors who are willing to make donations. And right after the recession, they had a real opportunity to do a lot more work and a need to do a lot more work and didn't have that money up front. And in that case, over the course of 3 loans, we were able to get them around $900,000 of working capital that, again, many of you in the business world know. So those are the examples of the kinds of deals we do. We are one side of impact investing. We are very socially focused. We are a nonprofit ourselves. We borrow from banks who have a motivation socially to lend to us, as well as from private foundations. There's a wider range. We just wanted to kind of get concrete. And then very quickly, to answer your question, why the momentum now? I mean, I'll turn that back on you. You said in the last few years your clients are getting more interested in this. One part of the momentum comes from that, and I come back on the other parts, but just wanted to hear more on what you're seeing from your clients.
Before I get to sort of what we're seeing in terms of interest from our clients, I think I'll talk a little bit about a signature transaction that we did that really in some ways was the catalyst, even though it really is only one single deal, but I think it's a real example. So, as Antony talked about, and as I talked about earlier, I think there are folks like Nonprofit Finance Fund, Goldman Sachs, where we have really developed the technical expertise to be able to lend to non- and for-profits that are doing things like building community facilities, financing affordable housing, as well as have gotten better at understanding the underlying cash flows that are often quite complex associated with government contracts that enable you to provide working capital to nonprofits. And so those are very important tools. More recently, people have spent a lot of time talking about how do you use those tools and apply it to a need for social services. So we're all in a time right now where there really is less government funding available. We all know that no matter how much philanthropy is out there, there's not enough to solve social problems. Some very smart folks in the UK got together maybe 3 or 4 years ago and began having conversations about how can you think around this problem and how can you use some of the tools we have in the private capital markets to address some of these challenges. And what was born out of those conversations are something called social impact bonds, which are in fact not bonds, but somebody called them that, and that's what they've been continued to be called. How do you provide upfront financing to a nonprofit, or it could be a for-profit? To date, it's really focused on nonprofits, to provide important social services where the source of repayment is a contract on the other side for that to that nonprofit that pays based on outcome rather than paying based on service delivery. So typically what happens, we're all used to government contracting out for services. Typically the way the government does that is they do it through a cost reimbursement contract. I need more daycare slots or more early education slots in my community. Nonprofit, I'm going to provide you money to pay your teachers, buy supplies, to get more tushies in the seat, as I say, right? That's how you expand. And what everybody does is the government funds those programs, and then we all hope that we're going to get the outcome we want, that more kids are achieving at grade level. The way a social impact bond works is it really turns that on its head, and instead what it does is it says, you know what? I'm going to be a good steward of government money, and what I'm going to say to you, provider, is I'm not going to pay all your expenses up front. Instead, what I'm going to do is pay based on agreed upon outcomes when we know those kids are on track on grade level. The challenge then becomes for that provider, well, how do I pay my teachers? How do I buy supplies? And that's where private capital comes in. So what we've done is Goldman provides the loan to that nonprofit. They hire the teachers, they buy the supplies, they recruit the kids. All the kids go to school for a year. And then we track those kids in kindergarten through 6th grade. And the county then pays based on those kids being on grade level. And so if you step back from all of the excitement about the social impact, what are we really doing, right, on a financial basis? We're providing them a working capital loan against the proceeds of a contract. The difference on that contract is that that contract is about a social outcome. And one of the things we're very excited about with this is that our return tracks with the outcomes. So the more kids that do better in school, the better the return for the investor. And so we think this is a very exciting new tool, and I emphasize new. I think it was Antony who on a panel famously said, never has there been more talk and less action. I'd like to say that we are leading the action part of it and not as much on the talk, as we've done 3 deals using this structure, which is still not a lot, you know, in the world, certainly in the world of Goldman. But back to sort of what we're seeing from clients. So when we did our first investment like this, we thought it was really an exciting way to use both our human capital, our structuring expertise, and technical understanding of public-private partnerships, as well as the firm's capital to make this type of investment. And the first deal was around financing preventive services on Rikers Island, which is the New York City jail, where the potential to have impact is quite staggering. In fact, the recidivism rates before this project for 16 to 18-year-olds in jail in New York City is 50% within 1 year. And in fact, 90% of those young men have not been convicted of a crime. So they may have done something bad, or they may not have. From a field perspective, what happened was when that investment was announced, there was a bit of a groundswell from our clients where the phone kept ringing from colleagues literally from across the world saying, wow, this is really interesting. This is really compelling stuff. We care about these issues in our communities. Can we co-invest? How can we have exposure in our portfolios to investments like that? And we really have spent the last, year and a half really trying to focus on how to be responsive to that. And for us, we think it's a very exciting moment because, I would agree with Antony's characterization that there's a growing understanding that there's not just your right and your left hand. I can't do that with my microphone. But that there really is this middle way where you can invest in a way that has an intentional social impact. And we're very excited that, our clients join us in that interest.
Yeah, so I think there's really 3 elements to why this is growing. And Andy's talked about the supply from clients at Goldman. I did this before I joined the Nonprofit Finance Fund. I led an initiative at the Rockefeller Foundation globally to kind of encourage and understand what it would take for more private investment capital to flow into the kinds of deals that solve the social issues we care about. And so I think there's really 3 parts of it. On one hand, there's the supply. There are more people who are making more money at a younger age through business. who at age 40 are suddenly worth huge amounts of money, more than they'll ever need, who are saying, I've made my money through business, and I didn't think of business as an evil thing. The founder of eBay, he made $10 billion, Piero Midyar. And he said, when I made all this money, people said to me, now's your time to give back. And he said, I never felt like I'd taken. I built a business that I thought was creative, and I thought that we were doing things, creating opportunities for others. So I want to make a difference. He's an incredibly generous guy. He drives around in his old Subaru, despite being where he's going to give away most of his money or invest it in impact investments. But what he said, it didn't make sense to me that the only thing I could do is give my money away, because in my own life, business was an engine for doing some things more than just making money. So he's been a real pioneer on the foundation side of integrating grant-making investing. There's an issue around generation and gender. U.S. Trust did a study of very wealthy individuals a year ago and said, would you be willing to give up a little bit of investment return or take on more risk in your investment portfolio if that meant you could create social difference? Huge distinction between the millennial generation, who's really excited about this, and the baby boomer generation less so, and a difference not quite as large but substantial around women versus men. Women are more inclined to do this. One of the demographic things that's happening, there's going to be a $30 trillion wealth transfer in the US over the next 30 years. Because women live longer than men, there's going to be a period where a lot of, I hate to say this, old rich men are going to die and their wives are going to take over the family finances. It's a fascinating opportunity to create impact investing vehicles that are providing women investors with what they want more than the men around impact. So I think there's a supply. I think the other really important point is demand. And those of you who operate here in the community or your philanthropy, either analytically or viscerally, because of the conversations you're having with your grantees, that our social system is in crisis. And the Nonprofit Finance Fund, we do a survey every year, the state of the sector. It's a survey of nonprofits around the country and their financial health. And what we know is that for the first time in the last 2 years, half of all the nonprofits in America say they did not have the resources they needed to meet the demand that was showing up at their door. And for the business people in the room, demand growth is a great thing. When you run a homeless shelter, a soup kitchen, an early child care center, an aging center, demand is a tragic thing if you can't meet it. And our social system is currently not figured out how to get the money, enough money, because government's retreating, to meet the demand that is growing. And the Nonprofit Finance Fund, we don't think that's cyclical. The recession made this really obvious. But last year, the economy grew, unemployment went down, and social service agencies in New York said that they had an increased demand for the services. Homelessness has doubled in the last 12 years in New York City. There's 50,000 homeless people, 1/3 of whom have a full-time wage earner in the family. Our society has gotten to the point of inequality and government retreat so that there's a real demand for these organizations to get capital from somewhere. You guys in philanthropy cannot fill the gap being left by government. So there's a real interest in how do we find money elsewhere. So there's this moment where supply is coming, demand is desperate, and I think it's true in governments. This is why governments are so excited. County officials, city officials, state officials, the federal government are very excited about this. And then the last piece, so we've got the money that wants to be placed, we have the need. We also increasingly have incredibly savvy and effective leaders of social change organizations, mostly nonprofit, a few for-profits, who are able to engage in this world in a new way. And I think, I'd love to hear more about some of the deals you've done, but I suspect that a linchpin in all of those deals is an incredibly inspiring, analytically driven, disciplined manager leading that organization who says, rather than just trying to make the old system work, and as hard as that is, I'm going to take the leap of faith, maybe it's not faith, but I'm going to take that leap to try and get onto something else that's more sustainable. If we didn't have that third piece, this wouldn't work. We've got all three in place. We have an interest in moving the money, a desperate need to do things differently, and a growing group of organizational leaders in philanthropy, in government, in nonprofits, and in business who want to do something different. And so you put those things together, and it's an incredibly exciting time, although we will get honest and not be Pollyannas and talk about how hard it's going to be to make it actually happen.
Right. I would agree with you completely, and I do want to underscore this notion about the sort of social entrepreneurs at the front line. There's not a deal we could have done without an incredibly committed, incredibly business-minded leader of a nonprofit. And having spent a chunk of my career before going to Goldman Sachs in the nonprofit sector, what I often find myself reminding folks is that nonprofit is the wrong term. They should be earning a profit. It's just who that net revenue goes to. is different. And a nonprofit, by definition, reinvests in themselves. But increasingly, there is this group of social entrepreneurs who are really the enablers of these types of investments, who are willing to take risks with their organizations, their reputations, and their balance sheets to be part of some of these transactions, rather than the sort of older way of doing business, which says we just rely on grant funding, because that's not going to be available, I think, moving forward. So with that, I think maybe it makes sense to start talking a little bit about the different roles that philanthropy can play, because I think one of the things that we always talk about is the idea with impact investing is not a replacement for grant making. It's another tool in the toolbox. And I think that in most of our transactions, to steal the phrase, it really does take a village. We just did an investment in Massachusetts to finance, again, services for at-risk youth. We had, let's see, 3 foundations at the table, a venture philanthropy organization, a consortium of foundations, and a large financial services company. So it really took, as well as a nonprofit that had some risk in the deal, it really takes all of those folks. And when we think about those deals, we really think about it in terms of the capital stack to get it done, or what the different roles are. And we tend to view the real role for grant making as critical to what we do. And so that's the early risk capital. It's the how do you finance innovation? Well, you do that with grant dollars. When we don't know something's going to work, I can't go to my investment committee and say, we're really hoping this is going to work out, but fingers crossed. No, they want to see data that a program's going to be effective. They want to see a track record. And that's right, because that is then at the point of being an investment where we're expecting a financial return. Philanthropy plays a really key role, which is that those early dollars or those riskier dollars. We also work with foundations that are making PRI investments or program-related investments. I'm always trying to explain program-related investments to my colleagues at Goldman Sachs, because they keep saying to me, wait a minute, it's high risk and low return? That's not how it's supposed to work. And I try and explain to them that no, these are, foundations that are doing this because of the programmatic impact, and that's exactly how it's supposed to work with PRI dollars. And so, again, they're a critical piece of the capital stack that's really catalytic, that is really then enabling, in some sense, what we do, which what I would define as commercial impact capital. So still driven towards impact, but typically it's going to be risk-adjusted returns, not that high risk, low return. So we really see it as a continuum, and I'd be curious what your thoughts are on that.
Absolutely. I think one of the challenges is that this sounds really sexy, like, great, I can make lots of money and do good. Well, who wouldn't want that? But it's hard to do. And the organizations that are doing it, I mean, if this sounds like brain damage, try and actually get a deal done. The organizations that are doing this, especially the nonprofit organizations, they're taking a big risk to do something differently. We know from our survey that most, and you know from your grantees, most of these organizations have, in the best of days, 1 or 2% margins. They don't exactly have war chests that they can spend while developing new programs. So there's a very simple role for philanthropy, and that is give grants to great organizations who need the space to do something differently. So there's a great example. I don't know if Dan from California Endowment is here. I think he was on the list. Oh, hey, Dan. So the California Endowment did a very interesting grant to a nonprofit organization in Fresno, which focuses on helping poor kids control their asthma. So as many of you know, asthma is tragically co-located in America in very poor neighborhoods and typically minority neighborhoods. It's where we dump our toxic waste dumps that don't get cleaned up and our long-haul truck depots that create a lot of bad smog and so forth. Shouldn't say that too glibly looking out the window. But asthma in Fresno, like in many communities, is much worse in really poor communities. And the kids who get asthma end up having to go to ERs, which is terrible on a human level for the kids. Their parents lose days from work, and many of them don't exactly have jobs that have, pay them when they're not working, so it hurts the family's income. And it turns out that there's a nonprofit in Fresno that has figured out there's ways to reduce the number of times that these kids have to go to ERs. Simple things. Put new windows in so you can block out some of the pathogens, put a simple filter in the house that filters out the air, and help the families understand when the kids should go outside and when they should stay inside. So it turns out that this is actually, weirdly enough, something you can write an investment deal around. Because when these kids don't go to the ERs, it saves the hospitals money, and it saves the insurance companies money. So eventually there's an opportunity to do a social impact bond, as Annie described, where you could put millions of dollars to this nonprofit, help them grow the number of kids they can serve, and the amount of money you're going to save in reduced hospital and insurance bills is going to more than pay for the intervention. So you can structure a deal. But before you can, this nonprofit has to go out. They have to build the infrastructure to run this program. They have to do assessments. They have to get evaluators in. There's a lot of work that's going to have to happen before it's investment ready. And in that case, a grant from the California Endowment is laying the works for what eventually could enable investors to scale this up. And again, we're not in the business of making life easy for investors, but we are in the business of helping to make sure that fewer kids in Fresno have emergency room visits because of their asthma. So I think that's one case where a grant is a really powerful way to complement this whole force we're talking about. But there's also another way. With many of the deals we do, frankly, if the financial setup of the deal was enough and compelling enough to get the deal done, the deal would get done. It would get done by the banks. And so most of the deals we do that are high impact, the reason why we're doing them is because there's a value of the social mission that makes the deal worth it to us, but that without that, you can't really make the economics work. So we often work with foundation partners who don't necessarily put grants in, but who are willing to come in, mostly through PRI programs, as investors taking on more risk, which allows people like us to put the deal in. So just one specific example about that. In Flint, Michigan, some of you might know, Flint is one of the most devastated old factory towns of the Northeast. Had an auto plant, it left 30 years ago. Before we were talking about Detroit, Flint kind of went through that years before. And in downtown Flint, there's an abandoned old newspaper. So you take Flint, Michigan, which has its own problems, and you take the newspaper industry, you put them together. So there's abandoned old newspaper headquarters building, and Flint will never revive as long as that building stays there as an eyesore, and no one's going to invest in that community and so forth. So a creative partnership between the Michigan State University to put in a little teaching hospital, some housing developers who said alongside the teaching hospital we can put in some low-income housing units that the med students can stay in. The local fresh food movement said that's a great place to put a fresh food market because 17,000 commuters come through there every day and they have no access to decent, healthy food because they live in a poor community. All of that together meant that if we could get the financing in place, we could rehab that building, turn it from an eyesore into something productive, and create a real sense of hope and energy in a community that desperately needed it. That is something we can lend against, and the Nonprofit Finance Fund was able to make a loan alongside with some government money through a tax program, but there was a crucial role that a small family foundation played, and that was their willingness not just to put a little bit of loan money in, because we had the money, but to put that money in and take a little bit of the risk out, so that if this loan goes bad, they will pay, they'll pay us, the other lenders, before, they'll take sort of that part of that loss before the rest of us do. And that was necessary for us to be able to get into the deal because we borrow money from people like bankers who want to get repaid, so we are quite risk averse. So I think those are two examples. You can use your grant funding to kind of complement all of this energy, and there it's really about leverage. That grant from the California Endowment, if this works out, is going to result in millions of dollars of flows of capital to the organization they care about that they didn't have to spend. Or you can actually get in onto the deals. And Andy's been very creative in her team of bringing foundations in. I think in every deal you've done, there's been a role that a private foundation has played to make the deal a little bit less risky so that the other capital can flow.
So adding to that, I think the one piece that you didn't get to that I would put on, because I think that was a great way to describe it, is that there's also a role for endowments in this space. And I think that this is a newer conversation that's happening where foundation investment committees are beginning to say, how can we, within our corpus, within our traditional portfolio that's supposed to be just here, my right hand, how can we begin to think about aligning that with our values? And I think, in all honesty, sort of truth in advertising, I think it's a complicated conversation. We've talked to lots of foundations who will say to us, well, half my board thinks it's the best thing we could ever do, and the other half thinks the other half has lost their minds. And that's not our job. We have a fiduciary duty to always seek maximum return. And that is what I would say a very current conversation that's happening, both, I think, in foundation board conversation, but also at a policy level. One of the things that happened last year in association with the G8 was that Prime Minister David Cameron gathered a group of people together to spend a day talking about impact investing, and sort of who would have thought, right, that it would be a conversation at the G8. What was a result of that was spawning national advisory boards across the globe to really look at both the local and global policy issues around how do you begin to think about using some more capital market solutions to address pressing social challenges. And so within the policy context, there's also conversations about, well, what has to happen in Washington to help facilitate this happening on the ground and give some clarity to what are often very complicated IRS rules. And so there are exciting things happening on the policy front too that are really responding to sort of all these components that are happening down here on the ground that I think are quite exciting.
And I think this goes back to where I began. If you believe that the only purpose of investing is to make money, and that any attention you pay to the social impact of your investments by definition means you will not make as much money, then it's very hard to have this conversation with your endowment's investment committee or board. On the other hand, if you believe that there is a gathering storm of evidence that if you are smart about it, you can both make money and also target social issues you care about, then the fiduciary duty of an endowment's investment committee becomes very interesting. Because what is the responsibility of someone who's charged with investing in endowment's assets? In the world in which the only purpose of investing was to make money, it was to make as much return as possible with the risk parameters that were reasonable so that you could pursue the social mission through grant making. In the world we're describing, life becomes much more complicated. And I think there are lots of people who are quite judgmental about foundations and say, why are you guys not changing? And the truth is this is really hard because foundations have been set up with a tax code, a set of practices, human resources. You'll put your social issue people over here, your investment experts here, you put them on different committees. If the endowment is managed internally, they don't like to sit in the same building. They definitely don't want to be on the same floor. The program people think the endowment people are mean and avaricious, and the endowment people think the program people are intellectually lazy and sloppy. I mean, you guys know what I mean. And so there's some, but on the, and that's where the bulk of foundations are. But there's a growing evidence that you can think in a different way. And I use the word belief intentionally. It's hard to win this analytically. You can't. You cannot convince people who believe one thing, no matter how much data you bring. It really is belief. And there are examples of foundations who've really been able to get around this. And I just would encourage anyone who's interested. Last week, the Knight Foundation in Minneapolis, it's a $2 billion foundation, announced that they will be setting aside 10% of all of their assets for an integrated impact investing program that will include program-related investments as well as the endowment. Another really encouraging story is the Rockefeller Brothers Fund, not the Rockefeller Foundation where I work, but the Rockefeller Brothers Fund, another foundation out of New York. They're around $600 million in assets. They were capitalized 2 generations ago by the grandsons of John Rockefeller, the original one. They have 5 years ago said to their outside endowment manager, we would like 5 to 10% of our endowment to be targeted around impact. We don't want to give up return. We don't have to do the kind of deals I talked about. No one expected their money to go into Flint, Michigan. But they said, we want there to be an impact. We want you to be intentional about a certain part of our money targeting the social issues we care about. Their outside money manager said, we think this is impossible. And the board of the Rockefeller Brothers Fund said, we think it's possible. And they went back and forth. And finally, the Rockefeller Brothers Fund board called the bluff of their asset manager and fired them. And about 6 months ago, they said, rather than just the 5 to 10% we had asked you guys to manage for impact, we're going to make an RFP and ask investment managers who wants to manage all 600 million. And they haven't, I don't think they've announced it, but they're about to announce the winner of that contest is an asset manager who has made a convincing case that they can be good stewards of the returns of that endowment over time, at the same time that they can take at least a part of it and invest it in a way that is aligned to impact. So, for all of you who have lawyers and relatives and others on your boards telling you this isn't possible, it's not easy, it takes a lot of attention, and I don't want to dismiss the fact that this is difficult, but I think we're beyond the point now where we can say, we can have a debate about whether it's possible or not. It is. It depends on the will and the creativity of the foundation.
So before we open it up to questions, I thought I would throw one to Antony. So 5 years from now, we're back here. What's your story? Is it good news?
Yeah.
Is it bad news?
So I think normally you answer that question by saying, this is all great and we've changed the world. I prefer to do what's called a pre-mortem. So 5 years from now, impact investing has died. So let's say, what's the post-mortem going to be? Not to end on a depressing note, but I think too often these conversations are very Pollyanna-ish. And I really think that it comes down to a recognition that this isn't going to be easy, and that it requires people to think in new ways and to work creatively in new ways. And one thing that's happened to me, I led an impact investing initiative of the Rockefeller Foundation. 2.5 years ago, I joined the Nonprofit Finance Fund, and what my team does every single day, and I have two colleagues, Jessica and Jason in the corner, wave guys, who are closer to this work than I am, but what we do on a daily basis is work on the ground with great nonprofits, inspiring investors in the real day-to-day slog of making this work. And I have to say, I've been quite humbled. It was a lot easier for me 2.5 years ago to get up on a stage like this and say impact investing is going to change the world. And I still believe there's huge potential, but it requires a lot of us to make the effort to think in new ways, to approach each other. Impact investing requires people who are unused to working together to work together. Andy's team is working with prisoners, young prisoners in the city of New York. They did a deal in Utah with the United Way. It really requires us to come to this with an open mind. We have to give up our self-righteousness. At the Nonprofit Finance Fund, we have a motto on our board, be righteous, not self-righteous. You have to be righteous, because this is about the most noble work anyone can do, and we're addressing issues that are incredibly pressing with clients who desperately need our support. But if you get self-righteous, you start saying, well, we know better than everyone else, and those bankers don't know what they're doing, and those nonprofits are lazy. So it really requires a level of just, I think, humility, but also a willingness to do the hard things and not to sort of gloss over it. So that's one thing. And then the other thing I'd say is we can win on a level playing field. We've got a great evidence that this stuff works, but we're not fighting on a level playing field. We're fighting a world in which people have a specific mentality that makes it very hard to have an open-minded conversation. So I think if people are willing to do the hard work and willing to be open-minded, then I do think there's a lot that we can do. But we shouldn't mistake the impact investing movement for being something that can replace philanthropy. There's a crucial role of grant makers. There is an absolutely central role of government. I mean, government is central to this, as is grant making. All we're saying is at a moment when there isn't as much government money as we need, and philanthropists cannot fill the gap, let's figure out how to harness the assets and the power and the creativity that come in a team like Andy's.
Steve Hilton, Conrad Hilton Foundation. Andrew, you mentioned about the social impact bond. What kind of returns have you seen net of all fees?
If you don't include our time, right? Because I think, as Antony pointed out, these deals take a disproportionate amount of time to really underwrite and understand the risks. Where we see the returns as really in line with some of our other community development lending. So on a base case, and when we think about that, that's really about where we expect the impact to be. So those returns are at about 6 to 8%, with some upside to low double digits. As the impact increases, those then returns can also increase. One of the challenges in the social impact bonds is that it's very hard to understand the risk associated with these. There's a pretty well-worn path when we start to think about real estate and community facilities, and there are folks like Antony's team, some of my colleagues on our team who spend their life focusing on how do you build strong communities. In the case of social impact bonds, these are really new instruments. And so we spend a lot of time focusing on how can we align the risk of the transaction with that return profile. Because we're realists, and what we know is when you're talking about a partnership with government and understanding how they think about things, there's not going to be unlimited upside, right? So, for example, in New York City, once the decrease in recidivism goes above 20%, there's no additional payment to the nonprofit that then uses those funds to repay us and would pay us additional returns. Those just get held onto, those savings and benefits just get held onto by the city. And so again, through some of what Antony talked about, we really focus on how can we put together a partnership where we feel like our risk is aligned with those sort of more or less high single-digit returns.
Thank you.
My name's Claire Peaks. I'm from the Durfee Foundation. I wondered if we could hover for a minute on the Flint case.
Yep.
And if you could help us understand, there were three entities you talked about: a hospital, affordable housing, and a food hub of some kind.
Yep.
So was it a pooled fund? Was it a single funder? Was there an intermediary? Because those are three very disparate activities.
Yep.
And over what time horizon was allowed before they started to look at a return? Like begin to say, okay, we've recouped our costs.
So the additional partner there is the government, because a deal like that typically, I can talk about the lending piece, and nonprofit finance fund made a loan. There's also a lot of government sort of subsidies that have to come in to make that work. That initiative is going to create revenues. Those revenues can pay back my loan, but not enough for the full project. So there was also a government piece. But the role of philanthropy was crucial. I believe it was the Mott Foundation, which is a relatively small local foundation. I'm looking at Jess, am I right? I don't know. I think it was the Mott. So they spent a lot of time putting that deal together. And it's one of the luxuries I realized when I worked in a foundation, I was able to go around, have meetings with people like Andy, and go to, talk to investors, because I didn't have payroll to meet in 2 weeks. I had a reliable source of salary, which is hugely helpful because these deals take a long time. So if your job is to try and make a living by getting deals done, it's very hard to get the deals that are going to take years to put in place. The Mott Foundation was in that community trying to make this happen for a long time before the deal finally came. So your question of the timing, I think once the partners were in place, the deal got done pretty quickly. But without that foundation being anchored, again, not to blow smoke at Dan, but the California Endowments role in the Freshworks Fund, that some of you probably are involved in here in California, was similar. Is Tina here? Not sure who it is. So Tina Castro worked at the California Endowment and spent at least a year convening the players, making the case, getting everyone around the table. That is a really crucial role, and it doesn't require a grant necessarily. It's the effort by someone who has a mandate to do that kind of work, even if the revenues aren't going to come right away. So to answer your question, there was a small piece that was a loan that was from us. There was a grant component. The Mott Foundation was willing to take, they made a PRI, but it took more risk. And then we tapped into a government program called the New Market Tax Credits. And I would say in that case, the main intermediary was actually the foundation that brought the partners together. A similar story here with the Alliance deal, the Alliance Charter School in East Los Angeles. We ended up doing a $9 million bond purchase. Even then, it couldn't have worked, except for two additional sources of support. One was that a congressman had written into the American Recovery Act a line that basically that bought down the debt of charter schools issuing bonds in California. Someone had a friend, which meant we are getting paid 6.5% on those bonds, but the school itself is paying out 3.5% because the government's paying the difference. So again, you don't get a deal like that done without government, even though those of us can come in and talk about the private lending piece. The other thing that happened was even then the school didn't have equity, or they didn't really have collateral, and so the loan to value ratio, those of you into real estate finance, was 90%. They only had 10% that they could really put up to support the loan, which even us as social investors is too risky. So then we went to the Department of Education in Washington, applied for some funding that allows us to put money into deals that make them a little bit less risky. So we put $450,000 of federal money into the deal, which turned the loan to value from 90 to 80. The details aren't important. I think what's important is that that's what this work requires. And at the Nonprofit Finance Fund, we've done 700 deals in the last 34 years, $280 million, never lost a dollar of our investors' money. We don't necessarily take more risk than a regular investor, but my team works their butts off to get deals done that otherwise couldn't get done because of this kind of complexity. A mainstream bank might ultimately participate in the deal and make money, but they don't have the mandate or the resources to spend the time and energy it takes to hit each obstacle that comes and say, okay, too expensive, we'll tap this federal program. Loan to value's not working, let's go and do this. And that's what I see in the impact investing world. It's not that people are softies and willing to do risky things, or it's not that we're not as savvy when it comes to getting paid back. We can't not get paid back because we borrow money from banks. But it's the fact that we value the social mission of the organization means we're going to work hard to get the deal done, and we're going to work harder to keep that organization going, even when things get tough. And it's not because bankers are bad people, but a banker, if you're funding a health clinic, what the bank sees from that loan is a stream of revenues to pay the loan back. As impact investors, we see those stream of revenues, and we see the fact that poor people in that community are getting better health care. And the fact that we value both means we work harder to get into the deals, and we work hard to keep those organizations going and providing those services when the deals inevitably go sideways, as they always do.
So in defense of bankers,
You're one of the good ones.
right, what I would say is I think that definition you just described is very true, and cross-cuts impact investing. It's not necessarily about the risk, it's actually about taking the time to structure the deal in a way that mitigates some of that risk and to bring together a very different set of players all around one goal, which is the impact, and then the capital can follow that.
So, Steve Board, this Board Foundation, 34 years. What's the average return you've had in 34 years?
Yeah. So we, right now, our average that we get back from clients gross is 6.5%. We tend to lend between somewhere between 6 and 7. It varies when interest rates drop, our rates drop, when interest rates go up, they go up. And against that, we've written off a 1.5% total of the 280 million. So it really varies. I mean, we just track interest rates.
One quick other one. Once you get involved with this as a private foundation, does your complete paperwork and what the government requires change immensely?
Yeah, so I ran the program-related investment portfolio of the Rockefeller Foundation, and I can tell you that because of some work done by the Ford Foundation in the late 60s, there is a part of the tax code that supports this if you're doing it on the grant-making side of your... So it's not that hard. Basically, it makes life a little more difficult for your auditors, who in addition to looking at your regular accounts, now have to value these kinds of investments on your books. That's one piece. And then the other piece is around, if you do it from your endowment, the whole question around fiduciary duty. And again, there's a lot of foundations that have gotten this done, and it doesn't require substantially more reporting. You don't suddenly become a target of the government's sort of, there's no agency that now going to pay attention to you that wasn't before. And if if your tax guys can't do this, there's 100 guys who can. So.
Right, so for example, if a foundation, which we have foundations invested in our fund, is doing this out of their endowment, it's like any other investment they're making. There's no special provisions.
I want to thank you on behalf of the Center for your presence today. Andy and Antony, I want to thank you. I think that this has been fascinating. We've learned a lot. I mean, certainly a couple of takeaways from me. Those of us who work in this sector understand that we are constantly challenged to provide resources for increasing demand. And as has been pointed out by both of our panelists, impact investing introduces a new way to provide new capital to address some of our problems. There is a role for philanthropy here, and I thank you for providing some insight on how philanthropy can get involved. But as both of our speakers said, this requires a new way of thinking. It sort of takes us out of our comfort level and forces us to think in a different way. So thank you for the inspiration, thank you for the information, and thank you all for